Hey, Winston Temple here with the Real Estate Template. Are y'all confused? Some of y'all confused about the jargon out there on real estate investing? The mumbo jumbo of the words. What does it mean? What does this mean? What does that mean? So we're going to talk about terms like, what does a cap rate mean? What does ARV mean? What does NOI mean? All of that seems overwhelming to most people. It is one of the most important things you're going to do is to learn the proper terminology so that you can speak to people about your real estate investing and what you're doing. And when somebody talks about the ARV or the NOI, you know exactly what they're talking about. Understanding the language in real estate investing is like having a secret weapon. It lets us analyze the deals, talk confidently to lenders. When you walk into a bank and you want to talk to the lender at your bank, if you are stumbling around on words, they ask you questions and you're stumbling to understand what they're talking about, do you think that makes you favorable in their opinion? They're looking at you saying, well, this man or this woman understands exactly what they're talking about. Or you think they're thinking, well, they're really winging it. So in order for me to step out on a limb with them, I'm going to have to take a little bit more risk. So it may make them a little afraid of you. So my thoughts are understanding the terminology on this right here will give you that ability to avoid a lot of rookie mistakes that people run into day in and day out. What is cash flow? We've talked about cash flow on a lot of videos. What does it mean? Cash flow is the money that's left over after paying all expenses on your property. You're going to pay your mortgage, you're going to pay your taxes, you're going to pay your insurance, you're going to pay your property management fees, you're going to pay stuff like that. What it is not going to do is your cash flow is not going to include money that you personally take out. Let's say you make $10,000 profit and you need an extra $3,000 to pay some other bills somewhere else. Your cash flow is not affected by that $3,000. That's something you took and used somewhere else. The cash flow from the business is still there. So that is just income that you would choose. So it's not included in your cash flow if you're talking about money that you pay yourself or doing something. But money you pay a maintenance guy, that's actually going to affect your cash flow. Money you pay a property manager, that's going to affect your cash flow. Everything else is going to affect it. Even your note is going to affect your cash flow. So for an example, if you have a rental house that's $1,500 a month and your expenses are $1,200 a month, how much do you have in cash flow each and every month? You should have about $300 per cash flow. And that should be very consistent if we run our numbers like we typically teach you to run numbers. We try and put every single scenario in running them numbers that can happen so that worst case scenario over here, best case scenario over here, you're okay with the worst case scenario. You prefer the best case scenario. If you land in between, you're still doing good. So that is our objective through running these videos and trying to figure this out, is to make sure that we set you up for success. So the next thing I want to talk about is going to be cap rate. So what is a cap rate? A cap rate is a measure of a property's profitability. It's net operating income divided by the purchase price. It's as simple as that. And that's your net operating income for the whole entire year, divided by your purchase price. Don't get it confused and just do it by 1 month because it's going to make it look worse. So a lot of people out there will say, well, Winston, you can't use cap rate in residential properties. I have people always, anytime I say it on a video, somebody's going to post it and somebody will make a comment that's right. You can't say cap rate in a residential. You can say cap rate. I can say cap rate wherever I want. I can sit in my bathtub and say cap rate and it doesn't offend anybody. Cap rate is cap rate. I want to know what if I was going to deposit that money in my real estate, or if I was going to deposit that money in mutual funds, or if I was going to buy gold with that money. I want to know how much money am I going to get in return on all three scenarios. And we're just going to use it as just a term. You can call it net operating income. You can call it cash flow. You can call it whatever you want. I want to know what my rate of return is. I want to know what the cap rate is on it, okay? And that's just my rate of return is what I'm talking about on this. Now, we're going to talk about that rate of return through cash flow. We're going to talk about that rate of return through cash flow plus principal reduction, if I got a note on it. We're going to talk about that cap rate on cash flow plus principal reduction plus appreciation. Okay? Now we got a fourth measure we can put in there. We can put cash flow, principal reduction, appreciation, and then depreciation from a tax standpoint. So there's 4 different methods in there. Now, am I going to get depreciation on gold? Nope. Am I going to get depreciation on crypto? Nope. Am I going to get depreciation on money I put in mutual funds? Nope. I'm going to get that on real estate. So that's one thing I can pull out. What about I put a note on something? I invest $20,000 and I buy a $100,000 piece of property. And I leverage that $20,000 across several properties. I'm going to get appreciation on every single property. I may only have $100,000 invested in it, but maybe I got $500,000 worth of property. So I'm going to get appreciation on $500,000, not the $100,000. So we're going to talk about all that. That is the secret sauce in real estate investing that so many people miss. They say, well, I wouldn't put my money in real estate if I can earn the same return on mutual funds, because mutual funds are so much easier. Put your money in, forget about it. Real estate is not as simple as everybody wants to play it out to be. It's not a very easy road. You got to be consistent with it. You got to stay on top of it. You got to pay attention to it. But it is the best way, in my opinion, for us to build wealth that lasts generation and after generation after generation. So again, if we take a piece of property that generates $10,000 a year, we're going to take that and we're going to divide that $10,000 by the purchase price. Let's say the purchase price is $200,000. That's going to give us a cap rate of 5% a year on that piece of property. And that is just off of the income. That does not take an overall throw-off rate that takes the other three scenarios into it. We're just talking about cash flow with that, on a capitalization rate with that. So the next term is, what is ARV? So how many people out there get confused about that? So before I tell you what it is, do you know? If you don't know, that is after repair value. So I go out and I buy a house, let's say it's a fixer-upper house, I pay $150,000 for this house. I look at it, I do the math on what it's going to cost me to do some repairs in this house, and I'm going to spend $30,000 on repairs. So I got $150,000 invested in it, I got $30,000 in repairs, so I got $180,000 invested in it, but it makes that house worth $220,000. So I bought it for $150,000, I put $30,000 in it, I got $180,000 in it, it's now worth $220,000. What is that spread of that money between the $180,000 and the $220,000? We got $40,000 difference in there, right? Is that right math? Is that the right math, Nick? 40 grand? Okay. If it's wrong, blame Nick. Nick's supposed to be spot checking me on this stuff. So let's say we got $40,000 of spread. That is forced appreciation. So now we put $30,000 in it, but we forced the value up another $40,000 more than $30,000, okay? So that's forced appreciation. Is that my money? It is my money. Can I go spend it today? Nope. I got to spend it through a cash out refi, or I got to spend it through a sale of the property. But I don't have the money in pocket until I do something to get that money out. But that money grows year after year after year, and that's compound interest. So the difference with compound interest, that means if I put an extra $10,000 worth of value into that house this year, next year I get appreciation off of that $10,000 there also. So we're talking more money, and that is the benefit. So I make another $500 next year that I wouldn't have made this year because of the appreciation I made the previous year. So that is the benefit of the appreciation. So net operating income, again, for everybody to understand, that is just total investment, right? Our total investment divided by, or our total income divided by our total invested amount of money we got invested in the property. And that's going to give us our net operating income. So next we're going to talk about equity. So equity is the difference between the market value of a property and the amount that is owed on the property. If your property is worth $300,000 and you owe $200,000, then what is your equity? Your equity is going to be $100,000. So if you do forced appreciation, and let's say you had another $30,000 through the forced appreciation, your equity would go up $30,000 more. So if we put more money into that $300,000 property, made it worth more money, or $200,000 made it worth more money, then that $100,000 we had in profit could grow to $130,000, $140,000, $150,000, $200,000. And that is forced appreciation, but that is equity that is inside the property. You can pull it out through cash flow, or you can pull that equity out through a cash out refi or a sale of the property. That is the two ways to pull it out. So what is the 1% rule? That is another thing that y'all hear me talk about, the 1%. I'm telling everybody now that if you can't get 1% on a property right now, you're not going to make any money. And what does that mean? That means if I buy a piece of property, that property is $200,000. If I can't make $2,000 a month, then I'm not going to make any money off of it. And at $2,000 a month, with interest rates where they are right now, I'm not going to make a lot of money. I'll make a little bit of money, at that number. So in order to make more money, I got to actually make it more than the 1% to make more money off of it right now. Now, once interest rates drop and we're able to do a cash out refi, yeah, we'll make great money off of that. During 2016, I think I was using an algorithm of 0.06 rather than saying 1%. If I could get to 0.06 of what the value of that property was, or what I was purchasing that property for, I could make money off of it. Now, as interest rates went up, that algorithm changed. So that algorithm is now at 1%. And that 1% is a break-even number right now. It's not a number you're going to make tons of money in. I'm just talking about not losing money. So right now is a harder time to make money in real estate because there's not a lot of really good deals out there. You can go out there and buy for, maybe 1.5% or 2% monthly income off of the purchase price. It's just not happening. But is real estate investing about get rich quick? I know we got so many gurus out there right now saying, hey, just buy the real estate. It's going to make you rich. You'll be rich in 2 years. You'll be rich in 3 years. It doesn't work that way. It really is in the mutual fund market or the stock market. You hear people say it's not the one property. You go out there and buy this one asset. You go out and you buy Tesla stock and automatically next year you're going to be rich. It doesn't work that way. You buy that Tesla stock and you wait 10 years from now and you're rich. You buy different stocks and you wait that long and you're rich. You buy a house and you wait that long and you're rich. And I think that the house is going to make you rich. I was talking to my brother this morning on crypto. We got some money in crypto, and he was talking about how over the last 3 or 4 years, where Bitcoin had dropped down, now Bitcoin's up to $100,000, and he said that's a pretty good return. And I was like, it is, but you know what? My real estate never made a drop in this cycle. My real estate still doubled in value, as same as that doubled in value. So it's just time and market. So it's whatever you're investing in, just understand. I mean, if you're looking for a get rich quick thing, man, they are. I'm not going to say they're not out there. They're just few and far between. There's not tons and tons and tons of them. So be careful. Be careful with that get rich quick mentality, because I do not think that life revolves on that. I think it revolves way more on you need to work hard. You need to put everything you got into it. You need to keep building until you don't have to. It isn't a matter of put some money into it, leave it, and eventually you're going to be rich. Yeah, that happens 40 years from now. 30 years from now. Let's do something we're going to make some money in the next 5 years. Let's get our net worth. And do I think you can take and build something from almost nothing to, $4 or $5 million in 10 years? Yeah, if you got nothing, I think you can build it to $10 million in 10 years. If you got a little bit of money, you got to ask a way to invest and produce more. Let's say you make a good money at your day job and you're able to invest more. Yeah, you can turn that into 5 years to make that money. But it is the fact that you got to sacrifice. Nobody that knows me would look at me and say, you know what, Winston doesn't sacrifice a lot to get to where he is, because I sacrifice everything to get where I am. And is that the best way to do it? I don't know if it's the best way to do it. It was the way that worked for me. That's all I know. And that's all I can share is what I have personally done. And I'm not going to shoot y'all a lot of crap on what I do and let you think that everything is easy when it's not. That's not my desire. My desire is to give you the truth. So the next thing I want to know is, what about a hard money loan? Do you know what a hard money lender is? So a hard money lender is, let's say you got a piece of property and you got equity in that piece of property, and a hard money lender says, look, I'll finance that piece of property. Let's say you don't owe any money on it, and they're willing to give you 70%, 70 cents on a dollar of what it's worth. So you got a property worth $100,000, they're going to give you $70,000 off of it. You're just going to let them put their name on the title as a lien holder, and then you pay them back in their time period that you're supposed to pay them back. If you don't pay them back, then they have the ability to take that house away from you. It's a hard money lender. So what's the benefit over a hard money lender and a conventional bank? The difference is a hard money lender, I can call a hard money lender right now and probably have money in hand in 2 weeks. If I call a bank, that's going to take me at least 30 days, 45 days to get that money in hand. So it's a lot quicker. The origination fees, the different fees they charge to get it done is a little bit cheaper than what a bank charges for the hard money lender. But the terms are going to be short. It's going to be a 6-month term, a 12-month term, maybe an 18-month term. But it's not going to be a long term with a hard money lender. They want in and they want out. They want to get in, make their money, get out. That's their benefit of that right there. So, it's great if you're going to do flips and you don't have money, you go to a hard money lender, you're going to pay a little bit more in interest rate. But if I pay a little bit more in interest rate and I'm not able to make that little bit more in profit, am I better off than not doing anything at all? I think I am. I would rather do something and make less money than do nothing and make no money. And I think too many people get caught up on the fact, well, I'm not making enough money. If you only made an extra $20,000, is it going to change your life? It may not change your life, but can it change the next investment you do? It can. Then you take the next 2 investments, now you maybe only got $50,000. Can that $50,000 get you the next one? No, but you can go buy another one and use that $50,000 and make it better. And you can keep growing that money. And you compound it. And you look at it and you say, okay, I'm going to make money off of my rents, but I got no money to invest to buy more rental properties. What do I need to do with that? Well, now I need to get another property. So what is the best way for me to get that. I may need to get a hard money lender to come in and get a property, do the rehab on it. Now I start renting it out. Now I do a cash out refi, pay off the hard money loan. I still own the property now. I still get cash flow, appreciation, depreciation, principal reduction. That is the benefit. That is the magic sauce. Closing costs. What does closing costs mean? Closing costs are fees that are paid to the bank or to whomever, to your title company, whenever you are closing a property, when you're purchasing a property. It's loans, it's origination fees from the bank, it's title insurance, it's all of that stuff that's included to make sure that when you buy that property, all of the due diligence has been done on that property so that nobody can come in and say, well, you might have bought that property, but this wasn't right. I just had a property that I was looking at selling, and I've been making a deal with this guy for a couple of years now to buy the piece of property. Not an expensive piece of property, not something I don't make any money off of really, but he's been living there for a while, and we agreed to do a lease option with him for a couple of years. And he's ready to buy it. Well, when my title company came in and wanted to do the closing, the title company said, well, the title description does not match what is on what is filed with the state. So what I had to do at that point is I had to hire an engineer. They had to go out and do some surveying on that piece of property. They had to come out and redo all of that so that whenever we gave it to the closing company, title company, that everything was kosher, everything was perfect, everything was good. That way when this particular person goes and decides they want to sell this house, they're not slapped in the face with something and say, well, the description's wrong, and now they got to pay for it. So hiring a good title company gives you that ability, and they use my title company, so my title company is the one that caught that, and they said, hey, this isn't a good description, we can't sell this property like that. Now, when I bought that property, I didn't use the title company I typically use. I use somebody else's title company, which I do not recommend doing. I recommend building a relationship with a title company and using the same title company for every single thing that you can possibly use them for, because those relationships go a long ways. I don't jump all over the board with people I deal with. I try to deal with the same people all the time in the same situations. If I'm going to use somebody to do my brickwork, that's going to be the person I'm going to use every time. I'm going to use somebody to put flooring in, I'm going to use that same person all the time. I'm not trying to negotiate and save $500 here and $500 there. That is not my goal. My goal is a relationship. My goal, if it's way out of line, I'm going to go find somebody else. But if it's not way out of line, I'm going to keep going because I think that I benefit more off of using the same people. So LTV, what does LTV mean? Loan to value ratio would be LTV. So we're using LTV as the percentage of a property's value financed by a loan. So if they say, I'm going to give you 70% loan to value ratio. If you got a property worth $100,000, they're going to loan you $70,000. You got to come up with $30,000 difference, okay? So you borrow you got a $100,000 piece of property, you borrow $80,000, you have a LTV of 80%. So your loan is 80% of the value of that property. How do you change that? That was going to change every month when you make a payment on it. Who makes the payment? You pay the payment, or does your tenant pay the payment? For me, my tenant pays the payments. So that money is not my money, that money is their money. So when they pay the payment, that lowers my LTV because now I owe less money on it now than I owed on it yesterday. When it appreciates, that changes my loan to value also because the property goes up in value. That's my money. Can I pull it out? If I do a cash out refi, I can pull either one of those out. So that is the loan to value. So we talk about depreciation several times. So the question is, what is depreciation? So you buy a piece of property, and let's say it's a residential single family house. You get 27 and a half years to depreciate that loan off, or the value of the house. So I bought a house, it's $130,000 for the house. The value of the land is $30,000, so the house is worth $100,000. So I would take that $100,000, I would divide it by 27 and a half years. So 100 divided by 27.5, oops. And that's gonna give me $3,636 a year that I can write off. So that $3,636 a year that I can write off, let's say I made $50,000 that year. So off of the top of the $50,000, the highest part of my revenue is I get to take off $3,636 worth of money, and I don't have to pay tax on the money. Now, can I do that on my ordinary income? If I'm a real estate professional, I can. We're not going to talk about real estate professionals in this video, but if I'm a real estate professional, I can take it off of my ordinary income. If I'm not a real estate professional, then what I do is I take it off of my income that my real estate produces. Now, let's say I got $3,600 worth of profit for that real estate that year, I get to pull all that $3,600 out and I don't pay any taxes on that money that I made. Let's say I can pull a little bit of it, but I really didn't make any money off of it. Then that $3,600 actually goes to the next year. I don't lose the ability to use it. I just can't use it this year. I'll use it next year. And it moves and it moves and it moves. So they depreciate the value of your home of what the government is giving you as a real estate investor is a bonus. They're saying on your residential home, you will replace every single thing in that home over the next 27 and a half years. Are you going to? Probably not. But that is the benefit of what they give you. So you get to write off and not pay taxes on the total value of the home when you purchase it over a 27 and a half year period of time. And that is depreciation. It's a good tool. It's a good tool to not pay taxes and save money. As you get bigger and bigger and become a real estate professional, now you can move it to your ordinary income, which makes it pretty cool. Turnkey property. A property ready to rent out immediately with no repairs. So we went this past weekend and looked at some houses for sale, and a couple of them were turnkey properties. That means I could buy it and I could rent it. The problem was I could buy it, but I couldn't rent it at the 1% rule, so I did not buy it. I don't want to buy something that's not. So a lot of times if you're going with a turnkey property, a lot of times they will not meet the 1% rule. Sometimes they will. But if they do not meet your numbers, do not buy the property. Do not buy a property with negative cash flow unless you got an income coming in and you know beyond a shadow of a doubt, I can always make that note, I can always do this. Otherwise, buy something. Do not put stress on your family. Do not put stress on yourself trying to make a note every month. You might do it when you're younger, but as you get older, man, that stuff gets old. So we don't want to do that at 56 years old where I am right now. I don't want to do that anymore. I want everything to make me money. I want to be able to do it and not struggle throughout every month and things like that. I don't want to be put in that position. So I would suggest the same thing for y'all. Everybody's different. Some people, I had a huge tolerance for risk and stuff at a younger age. Here in the last 5 years, I've changed my attitude on the risk and I don't put myself out there as much as I used to. So that is up to you. You got to decide what you want to do or not want to do on that. But, you know, turnkey property, buying it, it's the easiest thing if you're a beginner. It's a hassle-free investment. You can go out there and do it. If the numbers don't work, though, don't do it. You may have to buy something and do a quick rehab on it. I don't know. But that is what turnkey. If you buy a turnkey property, it means that property is ready to rent on day one. House hacking, what does that mean? Living in a property while renting out part of property offsets the expenses. So let's say I got a house. Right now I live by myself, okay? I got 4 bedrooms in my house. Let's say I got 1 apartment in the downstairs of my house. Let's say I want to rent out that apartment to somebody. That apartment will be a house hacking thing. I could rent it out to somebody else. They pay me a little bit of money. I'm already paying a note. I'm just getting a little extra income off of my property. Let's say we are building a townhome development, or we got to slide it to build. We haven't started construction yet. We've pulled permits on it already. But with that particular development, we are looking at, I'm building 2 master suites in this condo, and what that's going to give me, those 2 master suites, it's going to give us the ability to house hack with it. I can rent it to somebody because rents are getting so much that a single person can't come in and pay the note on even a 1-bedroom apartment hardly. So we're going to do a 2-bedroom apartment or townhome, and they can split the cost between 2 different people. So it'll be kind of like a house hack, not quite a house hack, but it'll be kind of like that because 2 different people will share the same thing. So one person may rent it from me and house hack it to another person. That helps them pay the rent. Now for me as a landlord, I got to sign off on whoever's living in that property because I'm responsible for that property and everybody around it, and I don't want somebody in there that cooking meth or something. We want to know who they are. We want to know who's living there. So we do pay attention to stuff like that. So that's house hacking. Buy a duplex, live in one side of the house, rent the other side off, tenant pays the mortgage, you there living for free, or you pay minimal amounts of money because you house hacked the second part of it. So it's not just talking about moving somebody into your existing home. It's talking about buying a duplex and house hacking with that. There's several different things. You can have an ADU on your property. You can house hack with that. It's just a different way to bring some money to your game or to your bottom line and help you be more successful. Next, we're going to talk about vacancy rate. I figure vacancy rate in everything that I do. So vacancy rate is the percentage of time that your real estate will be unoccupied. So let's say you got a tenant that rents that property for 1 year. At the end of the year, they move out. When they move out of that property at the end of the year, now you're going to lose probably a month's worth of income, chances are, maybe 2 months worth of income. You got to decide, what is the area like? You know, for me, I look at the area I'm in. It's fairly high demand. I'm 15 miles outside of Nashville. Typically, the houses rent pretty fast. I typically use a 7% vacancy rate, which allows that house to be vacant 1 month every 14 months. Now, sometimes I'll get a renter in there that stays for 5 years. Okay, that vacancy rate is still included in it. Am I paying it out every year? No, I'm not. But is it in there in my numbers in case I needed to be able to have it? It is. It is. And we put that in there. So the vacancy rate for me needs to change from place to place to place that I'm renting. Like right now, we've had so many units come on in Nashville, so Nashville's offering huge rent concessions right now. So they're giving people rent concessions to come to Nashville to fill all the condos that they brought on board. Now, that's affected the bedroom communities where I like to invest, because now the people that would invest in bedroom communities, because that's where they can now afford buying something in Nashville or renting something in Nashville. So they go to Nashville and rent it. Now, that inventory is going to be swallowed up over the next 12 months, and everything will go back to normal after that. So what does that mean for you? How do you find that out? That is part of the due diligence that you do. How many jobs are coming to our area? How big is the city? I live in a city right here of 6,000 people, okay, 7,000 people. There's not a lot of jobs in this city. There's virtually very few jobs in the city. So where am I looking for my tenants to come from? Am I looking for people that's going to rent from me to be coming from within my city? Well, there's not enough inventory of people in my city. So if I was going to buy somewhere, let's say I was an hour away from Nashville, I was going to go to the city that I'm in right now and I'm going to buy a property because I'm going to rent it because I can buy it at a cheaper rate. I may buy it at a cheaper rate, but what happens if I'm losing 3 months of vacancy? I have a 3-month vacancy between rentals. That'll eat up all your money you made over a 2 or 3 year period of time, all your profits. So you got to be very careful with that. So what my suggestion is, I look at, my community is not going to grow, not much. But I look at Nashville. Nashville's growing, I don't know, 90 people a day, something like that, Nick? Something like that. It's a big number. I mean, so they're growing at a decent amount of people a day. I got Hendersonville, Tennessee's got industry. Gallatin, Tennessee's got industry. Portland, Tennessee's got industry. And they all surround me. So I can draw tenants from everybody around me. Not just people out of my box. I'm drawing people out of other people's boxes also. And I bring them in and we rent to them. So I look at that and say, okay, I'm safe. Or at least I feel like I'm safe because I'm covering that basis. There's tons of jobs still moving into this area. There's new businesses coming in. You can call your city. You can find out how many building permits are coming in. There's a construction coming in. You can find out how many businesses are in your city. There's a new business slatted to come in over the next couple of years. Sometimes a business may have a plan to come into your city 5 years from now. You don't know anything about it, but your city manager does. Your planning and zoning people know about it because they're starting to do the process to bring that company in now. It happens years down the road. Okay, so the next thing we're going to talk about is a RIT. What is a RIT? It's a real estate investment trust. It's when a company that owns income generating real estate allows you to invest without owning the physical property. You can do that where, I know there's conglomerates out there that have 100 properties. You can buy stock in their company and you can handle it like that. It's a hands-off way of doing real estate. You're still getting the benefits of the real estate. Somebody else is just doing all the work. You're not going to make as much money in it as you could make on your own because you're sharing the profits. And if you don't have enough money to buy a whole house, it might be a good path for you to do it. I've never done a RIT. I've never invested in a RIT, but I know people that do. And what I would suggest is do something over doing nothing. Don't say, well, I'm not going to do anything because I don't have any money. Take what money you do have and do something for the next 12 months. At the end of that 12 months, you should have more money. Take that money and do something for the next 12 months. Then get to the point that you can take that money and you can go get your own property. That's my goal. Now, if you would rather do a RIT, then do the RIT if that's what works better. But I will tell you this, before I got too deep into the RIT, I might would consider going out and buying a Dollar General. What does that mean? That means I can go out and buy a commercial property like Dollar General. Dollar General runs the store. I own the building. Maybe I charge them $20,000 a month, but it's a triple net lease. So if my note's $5,000 or $15,000 a month, I charge them $20,000. I make $5,000 a month clear profit on that for the next. It starts out with a 20-year contract. Maybe you have a rent increase after 3 years. Maybe it's after 5, depending on how they write it up. And then your rent increases start coming. When they start coming, you're making more money, more money, more money. And there's a lot of people. It's hands off. It's completely hands off. That's mailbox money for the most part. You don't do anything. They maintain that property 100%. And I got a friend of mine that's an engineer that's retired. He's not retired, but he's not working as much as he used to work. But he took all of his real estate and he sold all of his real estate and he went in and bought stores like Dollar General, stores like let's say maybe they just buy a Chick-fil-A building or something like that. I don't know if Chick-fil-A does it or not. I know Hardee's does it, or not Hardee's, but Arby's and places like that do it. So just find something like that. They buy the building that has a 20-year term. Let's say it's a brand new building, because if I was going to buy one, I'd want a brand new building, because that's going to give me a complete 20-year lease. So that's good money. It's good money for 20 years. You ain't got to worry about it. And if you're in that stage of your life where, hey, I just want enough money to get me through, that's the best way to do it. It's just completely hands off pretty much. Escrow, what does escrow mean? That's the next thing we're going to talk about. So if I was going to talk about escrow, what does escrow mean? It's the neutral account where funds are held during a transaction. So if I'm going to go out and I'm going to make an offer on a house. I'm going to offer you $200,000 for your house. You want $220,000 for it. I'll give you $200,000, and I'll give you a $5,000 deposit. They accept my offer. I write the check for $5,000. I give it to my title company. They put it in an escrow account, and it sits in escrow account until we close it. Then whenever the bank closes their part of it, they're going to open up an escrow account also, and they're going to put money for your taxes and for your insurance and stuff like that, so that they know that every year you're going to pay them the note, they're going to pay your property taxes, they're going to pay your insurance, to know that they don't ever have to worry about that house not having insurance. They don't ever have to worry about that house not getting the taxes paid. So that is an escrow account. Whenever you do a loan like that, they are going to have an escrow account. I have an apartment complex well, not my apartment complex, I don't have anything in escrow on that. But I got a neighborhood that I own that required me to put $140,000 into an escrow account in case something goes wrong with that property. So I got $140,000, whatever thousand, that sits in that account, and it sits in that account if I need to buy all new refrigerators, all new dishwashers, all new stoves. I can go in and buy all of them at one time, spend that money, then they're going to require me to replace that money over a short period of time to put that money back into escrow, so that if another thing happens, a wind comes by and blows the roofs off of 10 units, do I have the money to pay for it? They want to make sure if you got multiple properties, you got enough money to handle it all. And that is the benefit of it, and that's what escrow is. So, it's used in all conditions. All conditions, whenever they hand on your money, it's just making sure that the bank is covered, making sure that you're covered. It really is a protection element for you, to keep you from getting into trouble and not mess you up. It's a good thing. We've given you 15 things to think about. I'm not going to give you more. We'll do another video to give some more, but it gives you a way that you can dive a little bit deeper. You can check out how to analyze property a little bit better. You need to go to some of our videos and look at that, but as you do that, you start understanding, what does it mean for your ARV? What does it mean, how much equity do you have in a property? How is that equity? How do you get forced appreciation? And forced appreciation increases your equity also. So as you're doing this, you just understand the flow of the terminology of the real estate is, and as you're talking to your bankers, as you're talking to people who do investment for a living, and you keep talking to these people, they understand that you know more and more and more about what you're doing, and they don't feel uncomfortable talking to you. It means something whenever you're talking to people and they understand that you understand what you're talking about. They're more apt to help you with an investment and put their name on the line for you. So thank y'all for watching. If you have any questions, please put them in the comments below. Let us know what you need. Let us help you. Thank y'all very much. Have a great day.